Hey everybody, this is Bob and Phil at Trade Genius Podcast. Guys, when they lie, your portfolio dies. And we're going to show you the setup. I mean, it was a master class in deception. Stay tuned.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. We're running our February specials. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that.
Hey Phil, look, you and I both know that they were manipulating the numbers, probably even more so than they normally do. Do you want to kind of show people, how this works now that we're starting to see some revisions?
Yeah, so I think the interesting thing that came out was all of the revisions to the CPI number, and so we can dig into that. Number one, December PCE inflation revised higher by 0.3%. The core PCE, which the Fed really keys in on, revised higher by 0.2%. December CPI inflation revised higher by 0.2%, and November CPI inflation revised higher by 0.1%. And then they changed the CPI calculation again. So, when these numbers come out, it doesn't give you a lot of confidence that you're seeing the real thing. And in fact, everything was worse, right, than the numbers you got live. And they know this, and I think that's why a lot of times when we're looking at the data, we'll look at things like liquidity. Well, a large driver of that is the banks, and the banks are the smart money. They're talking to the Fed. And so when you see things going south, even though the price in the stock market might not immediately reflect that, there's probably danger under the hood. And this is how it comes out. If you pay attention to these revisions, and it happens with employment numbers too, they're constantly getting revised, and it's usually for the worse right now because things are heading for a recession. And how you can know the banks are on top of this is the CFTC releases data, and it shows you basically what the positioning is by the banks and the bigger institutions. And I know there's a lot of numbers on this, but what the main number or the column that matters is the one all the way over there to the right. And you can see those big negative numbers. That tells you that the banks are massively short here. Okay. And they've been acquiring a short position. So while Bob and I were telling you guys, hey, look out below, as the market was going up, and we were seeing comments like, Bitcoin's going to 30K and the market's not going to really pull back. It's going to keep going higher. Economy's good. Well, the banks are telling you otherwise, and the revised data is now telling you otherwise. So, and this is how they get retail, because now it's all of a sudden it's like, oh, the data changed. Well, you have to look ahead of that. And the way you do that is by looking at the underlying data like liquidity, because that's really telling you what the banks are doing down the line. Another interesting chart Bob came up was, a lot of people like to look at the '08 stock market chart because we've been following that, but I think this probably gives us a better idea of how this market's going to go. And if we overlay 1946 to 1949, and I understand that's a totally different era, however, conditions with tightening and things like that still affect the markets in the same way. We're just dealing with larger numbers, and you'll notice that we're kind of tracking this pretty well, which would imply that we're going to be basically looking at a bearish market going into the end, all the way through this year into 2024. And that's something, if you guys have been watching the show, we've been telling you that because of the yield curve inversion, this is a likely scenario. And we may even go down longer into further into 2024. But I think this is a pretty good fractal of, if you want to just have a big picture of like what we think is going to happen in the market, I think this is it. And it's implying that we're probably going to be making lower lows going down into summer. The other one I wanted to flip to was the live chart of the yield curve inversion, which is important to understand because a lot of people, when they make comparison to charts in the last 10 years, especially like with Bitcoin, they're not taking into account the yield curve inversion. And that's where we're at now. And you'll notice we keep going deeper into inversion land. I mean, we're smoking 2000, the dot-com boom. We're smoking 2008. And so that's significant. And it doesn't lie because it usually leads the recession. And there were some interesting comments too from the central bankers on Friday that basically, you got to listen to what they say. They'll tell you no, then they'll tell you maybe, and then they'll tell you, well, if it happens, it won't be that bad. And that's basically what they said with the recession on Friday. And to me, that was a green light that they fully expect recession later this year. So again, I would point to the chart here and showing you that we're deeply inverted, that typically that red section there below is the S&P 500 with those arrows pointing down. That red section section there is basically telling you that this is kind of the expected move, right, into the rest of the year as far as the market goes. So, Bob, that these are the kind of things I wanted to show people. And I think you and I have been on this for a couple of weeks now, warning people, and it's starting to play out. And we'll show a couple of other things, but I want to toss it to you on your thoughts on where we're at right now.
Yeah, I mean, we obviously seen it. That's why, look, big money can't move unannounced. That's why we were screaming about the liquidity thing. And they need a big stock market push like they got in January to basically sell it to you. You are the sucker at the poker table. And what I mean by you is that if you have your funds managed professionally in these passive funds, they basically now have sold into those funds while using zero DTE call options to keep everybody confused. And basically they're closing the door on you and they're locking you in, and they've walked away. Not only did they walk away, Phil, they went negative. They went short the market. They're going to profit from this.
Mm-hmm.
And I agree with you on I think we're going to probably have another push up higher in yields on the 10-year. And, that's been, whenever we see the 10-year push up, we see the market doesn't like that. It reacts very negatively to that.
Right.
And if you noticed on Friday too, my personal theme is that long energy, long shipper, short tech. Mm-hmm. And if you noticed with the yields going up, energy holds its bid. Mm-hmm. And the reason why I like the shippers is because of China and the Russian sanctions. Mm-hmm. And so they're creating an artificial shortage of shipping and tankers, and it's just giving us free money. So I think that plays out. You get really worried when energy can't maintain its climb. And then the whole thing goes down, I think, in a really big hurry. So that's my thoughts on this, Phil. I think you want to show a few more charts that kind of give us a little bit more clarity as to kind of where we think this is going. And I think you're going to also talk Bitcoin charts too, right, Phil?
Yeah. So yeah, exactly. We'll talk about that. We haven't touched on that in a little bit. So what we have up here is basically our breadth on this side, and basically the breadth is going down. You can see it's getting kind of toward our oversold capitulation areas where we would look for a short-term relief bounce. We're not there yet, and that could take several more days to play out. But one thing I wanted to point out to you guys, and why you need to be careful here, and why we've been warning, is that back here, you'll notice breadth came down into April, and you'll notice the market was up here in the 4,500s, okay, and breadth was coming down. And if you look also, what was happening over here was that we were up at our euphoric levels at that time. And so we went from about 4,500, and by the time that drop was done with a little dead cat bounce, we were all the way down to 3,700, okay? And there's a similar setup here, where breadth is down toward the lows and we're up at our euphoric levels here. We're breaking another trend line like we've done every time in this bear market. And we've got all these lows here down here calling. So we're expecting a very similar move. At this point, the technicals are telling us that. Of course, like I said, when we get down to these levels, and all of this stuff is updated in the newsletter. So if you guys are interested, head over to tradegenius.co/newsletter. You can pick it up there. But once we get into these levels, we'll get what we call a pity bounce, basically. But then we're looking for these lower lows to play out until we see this come back down to fair value. Fair value is telling us we're 370 points higher than probably where we should be, because this blue shaded area that you guys see, this liquidity, is going lower. And that's something else we've been talking about. The market follows liquidity down, and you can see, Yellen's been the factor in holding this up this last year, but she's getting into a rock and a hard place now because the debt ceiling has been capped, right? And essentially, she's only got so much more she can do. Whether or not she runs her account down to zero, and if she does, Katie bar the door, or she's going to try to hold it up until July or June, whenever they're going to have to rectify this to get her to issue more debt. Now, when she does issue more debt, that's also super bearish, because as her account rises, it pulls liquidity out of the market. I'm not going to get into the technicals of that. It's just that's what happens. And so we're looking for this liquidity actually to make a leg lower. And typically when you get these end of year spikes on liquidity, which is the bank positioning, like back here, we end up going lower than that. So we fully expect the gravity, as it were, to pull this market down, because liquidity acts like gravity. And if it's going lower, so is the market. The other thing I wanted to show you guys was basically Bitcoin, because I know you guys have been asking about Bitcoin, and Bitcoin pays attention to liquidity as well. So let me switch over to that chart. All right, so here's the Bitcoin chart. Now, something I hadn't worked up for you guys before, but I did now, is I did a calculation on basically what is fair value for Bitcoin. And one thing that stood out to me when I did this was that we hit fair value on this push up to 25K. B, when you're typically in a bear market, the fair value will act as a point of resistance. And I think right now, like you'll see this in the 2015, 2016 bear market, which I think if you're going to point to any bear market we were in, probably this one, because it was a little longer than ones in the past. And it was the closest thing we came to a recession in 2015, although we didn't technically go into one. So probably the closest thing that you could point to, even though I think this cycle is going to be a bit different as well. But it acts as a resistance. And where you really want to look at Bitcoin is when price of Bitcoin's $8,000 under fair value. I can't tell you exactly what that price is, but as this gets down there, this is something else we'll update in the newsletter. But you can see that if you were to just pick up Bitcoin every time it dipped under this accumulation line, I mean, the returns, not only are you getting at the lows of the cycle, the returns are just mental every single time. Even in COVID, when it crashed, you just knew, regardless of what was going on, if you just started dollar cost averaging in there, you'd make a mint. And we dipped into that too going into November. Now, one thing about what happened was, you remember Luna last year and also FTX, both of those pushed Bitcoin quite a bit under its fair value. Whereas before, we were trending above it. So Luna was back here in June and that pushed it down under fair value. And then FTX kind of had like that knockout blow and pushed us under. So my take is, if we do get into a recession, that'll be the first time Bitcoin's in like an officially pronounced recession, and we'll go down probably and retest these areas. But like I said, where that is on price, we don't know exactly, because it's going to be a function of where the liquidity level is and where price is relative to that. So if all things being equal, if $8,000 lower is it, then obviously we're looking, going back down toward the lows here. So that's something to keep in mind, that as we go forward, as we have these recessionary looks going into the data right now and pushing us lower, essentially, you could see that this probably isn't the greatest time to get long Bitcoin on a long-term position. It looks more like a short, and short term, without getting too technical, we're looking at about 19.5K or 19,500 to get down to. And what we're hoping is that if this whole area down here, this FTX low, was the low of the cycle, we really don't want to see Bitcoin much lower than about 18,300. If we do get below that, it opens this range back up again. Then that opens us up to test the lows. Okay, so that's kind of like the Bitcoin update. And as Bitcoin goes, so does all of the crypto alts and all that stuff as well. So probably more to go. I know it felt good with this pump, but basically this was more of a short covering rally, basically risked on everything, and crypto is very sensitive to that kind of environment. So you get a big pop. But now we're probably going to go back into a little quieter, more winter, and we'll have a couple of pops higher during the course of the year. But by and large, I think we're going to be looking at pulling back here quite a bit more, and then we'll do another update when we feel like we've got maybe a solid floor under us that we can bounce up from. So that's pretty much it on this update, Bob.
Yeah, that's great. Hey, guys, stay tuned for Monday. We're going to talk about how they scammed you in the energy area. And then also in the week ahead, we're going to talk a little bit about what volatility is going to be doing to you guys, and the tremendous opportunities it's going to present to us traders in this environment. So patience is the key here. Don't FOMO over your skis. Just wait and let these trades set up for you, because you're going to make insane amounts of money if you just let the trade come to you. And with that, have a great weekend, guys. Thanks a lot, Phil. Remember, like and subscribe, hit that notification, hit automatic all the time, so we can get these algos working in our favor instead of hoping that you guys see the notification bell.
All right, guys. See you on the next one. Take care.
Trade Genius.